just in case I forget to do it. But I'll just wait maybe one more minute to see if anybody else wants to join us before we begin. Gosh, guys, I don't know. Does anybody online live in Cape Town? Are any of you guys from Cape Town? Nobody. Yeah. Weather here, I'm in the Eastern Cape in Gqeberha, and we have gone right back into the middle of winter today. From last night and today, it's absolutely, the temperatures dropped right down again. I can see now it says that it's 11 degrees, which doesn't sound very cold, but the air feels a heck of a lot colder than 11 degrees, let me tell you. And I saw in Cape Town that it's been snowing. It had snow this morning on Table Mountain. It looks like quite a lot of snow. So we're going to be in for a cold. The rest of the week's probably going to be freezing as well. Where are you guys in Gauteng? I always forget. Gauteng or KZN? Is it also cold there? Pretoria and Joburg. It's very hot. You're kidding me, really? And Friday it's going to be cold. Yeah, we've gone right back to winter. Seriously, seriously cold. They even issued weather warnings yesterday because of high winds, and there's various structures that have blown down and all kinds of crazy things again. But it's going to be September in a couple of days' time, and then hopefully the warmer weather should start to... No ways, Chris. I can't. You know, I am literally sitting here with the hot water bottle on my lap. It's the only way I can sit in my office here and work, because otherwise it's too cold. And I make coffee basically just to keep my hands warm. Not for long, nearly September. And then the weather's going to start warming. Oh my gosh, that's crazy. Yeah, but it gets much hotter in summer in Gauteng than it does here as well. At the coast, we have a very mild temperature. It never gets super hot and it never gets super cold. It's kind of in the middle. So we're very lucky. Okay, so I don't see anybody else joining, and if they do, we've also got the recording if anyone else joins us. So guys, you saw in the I should have added that on. Maybe I'll go and have a show you guys now. In the semester planner that I drew up and posted for you guys, and also in the reminder that tonight we're just going to go and have a look at the various aspects of Learning Unit 3, Risk and Return. And then just to keep you in the loop, next week, 4th of September, we'll have a look at some of the aspects of Learning Unit 4, bond valuation. The week after that, we'll have a look at LU5 share valuation. And then we'll have 2 weeks, the 18th of September, the 25th of September, where we can do revision of past papers and questions and stuff to get you ready for your task 2. Okay. So that's the plan for we've got 3 learning units that you have to cover for your task 2. That's 3, 4, and 5. So I'm going to spend 1 week on each of them, and then we'll have 2 weeks to do revision of various questions. Okay, so that will give you an opportunity to have an overview of each of the chapters, what's in it, what you've got to pay attention to, what are the important calculations, and all that sort of thing. Okay, so for our LUs, any questions, sorry, before we start? Anybody got anything that they want to check? Oh, also, before I know, everybody will ask me about your assignments. I haven't finished marking them yet. Probably, what is today, Wednesday? You'll probably get the marks after the weekend. They were only able to issue the memo to me on Monday, I think it was this week. So they don't release the memos until after the day after the students have written. to make sure that there's no leakage of memos, but there was a problem with the uploading of the memo, so I only got it on Monday. So I will still be busy marking your papers this week, but the marks will be released. I'll let you know as soon as the marks are finished and that they're ready to be released. Okay. So how did you guys find the task? What did you think of it? I did have a look at the paper. You thought it was good, so you quite enjoyed it. Okay. Was different to the one that we had in semester 1. And I was wondering how the students would find this one. So Shasta also said not bad, actually. And you, Chris, how did you find it? Melanie, what did you think? Okay, that's good. Yeah, I thought it was a fair paper. They didn't make it too easy, but it also wasn't where the whole paper was too super difficult either. Different from the first one. But as always, let's wait for the marks. Okay. All right, so on the screen here, learning Unit 3 Risk and Return. Oh, really? Had you also, you didn't, oh my goodness. I actually, when I saw that, I actually thought the students would see that it was obviously a typo, the way that the extra zeros were kind of like tagged on, but you never know. So it was just as well, one of the students sent me a message and asked me, so I went and investigated. So it's just as well I actually did that and posted it, otherwise. But anyway, if you guys had have taken the value as it was typed, Chris, you wouldn't have been marked wrong, because obviously you would have been using whatever was on the paper, so you wouldn't have been penalized for that. Okay, so that's fine, and I'll always understand that when I'm marking, I'll be able to see what the students have done and why they did that. So with our Financial Management 3A, your Learning Unit 1, Role and Environment of Financial Management, is obviously just kind of like a scene-setting chapter. And the only calculation you've got in that chapter is the EVA, and the rest of it is all kind of like primary activities and financial institutions and financial markets, etc., a bit of background. So they don't usually bother too much about Learning Unit 1 when it comes to the exams, and it's not that much of a important chapter other than the EVA calculation. But from your time value of money and your risk and return chapter, those two learning units are very, very important for the whole of the rest of 3A, as well as Financial Management 3B, if you go on and do 3B as well. Because these time value of money is the chapter, as you've seen already, that teaches us about how we can work out the present value or the future value of any scenario that we are trying to plan or budget for, or trying to assess whether we should invest in something or not. And we use that in all the planning and estimating, budgeting, assessing of projects. Throughout the rest of financial management, you'll use those principles of time value of money. You'll see that coming up again and again, particularly the net present value. That's the most common one that you'll come up against. And then the other thing that you will see repeated through all the rest of the course, 3A and 3B, are the principles in risk and return. Because in financial management, these are the things that are at the basis of what we do. With all of the decisions that we make, we have to take the time value of the cash flows into account, and we also have to weigh up the amount of risk in a project, and there's various ways that we assess the risk in a project, mathematically or financially, versus the return that the project is going to give us. And you'll see in later questions, particularly in the capital budgeting application questions, they will constantly ask you to comment on whether you think that the company should undertake that project or not. And usually what you've got to do is weigh up the returns of the project versus the risks inherent in the project. So we learn all the way through financial management to build in, as financial managers, every decision we consider time value of money and the risk and the return. So these are very much like foundational learning units 2 and 3. Then when you get on to learning unit 4 and 5 and 6, that is when we are then looking at very specific types of investment and how we can value them. So bond valuation in 4, share valuations in 5, and capital investments in 6 and 7. So that kind of just helps you get a bit of background as to how all of the chapters fit together. And then, as I say, obviously for 3B, we'll continue on from what you're doing now and build on exactly on these same concepts that we're doing. So I just want to go to the learning objectives for this chapter, because remember, this is what they want us to have mastered, and what they will test us on are these learning objectives. So for LU3, what we have to be able to do is explain the fundamentals of risk and return and the various risk preferences that different financial managers have. So that's basically being able to define risk and define return, and just understanding financial management terms, what we mean by that. So you're probably unlikely to get questions on that specifically, but it is important that you understand that so that you understand what we are doing. Then the second one, describe the procedures for assessing and measuring. So as soon as we use the word measuring, that means we're going to do an actual calculation to put a value on something. The risk of a single asset. So we look at single assets, and then in LU3 calculate the return, the standard deviation and coefficient of variation of a single asset and a portfolio. So we'll look at single assets and we'll look at portfolios. So that's, I'm highlighting that because I just want you guys to remember that when you're reading a question, just always remember you're going to be looking for that information in the question. Are they talking about a single asset, or are they talking about a portfolio of assets? So portfolio is where we own 3 or 4 or 5 assets and we've got them together in an investment portfolio. A single asset is when we're just judging one investment on its own. So our calculations in this section here are the standard deviation. We've got 2 formulas for standard deviation, and then coefficient of variation is one little formula. So those are calculations that we do. And then LO4 is discuss the measurement of return and standard deviation of a portfolio and the various types of correlation that can exist between different number sets. So then correlation is one of the very important concepts that we have to understand, correlation and diversification. Because again, that helps you to understand risk and return, portfolios, why investors build up portfolios instead of just owning 1 or 2 assets, in terms of our decisions based around what we're going to invest in. Then we look at international portfolios. So the only part there that's very theoretical, international investments or international investments in our portfolio. So that's just a little bit of theory where we have to just have a look and see if we own an international asset, a foreign asset, as part of our portfolio, what are the additional factors that we have to take into account, and that the additional factors that would impact that particular investment. There's something else I'm looking for here. Where is it? Correlation. Oh, why don't I see it here in the very interesting risk preferences assessing? The other thing in your textbook, it's in 3.10 in your textbook, are the types of risk. And there's two types of risk. We've either got systematic risk and unsystematic risk. And you need to be able to define the two types of risk. And again, in terms of looking at the market as a whole, understand where systematic risk and unsystematic risk falls into the picture and how they will affect the way that you add assets to your portfolio as well, and the reasons behind the portfolio. I think they include that systematic and unsystematic risk in the diversification, in this correlation and diversification section. They don't mention it specifically, but it's included there. And then very lastly, at the end, there's something called the CAPM formula, which is capital asset pricing model. And that is also just a little formula that we have to learn that helps us to calculate the percentage value that an investor would like to earn based on the risk in a specific asset. So in other words, what we're doing there is we want to say for certain assets, for all assets, they all have got different risk profiles, and based on the risk profile of a specific asset, I am going to want to expect a specific return. So obviously, the riskier the asset, the higher the return is that I'm going to expect from it. So CAPM is just a simple little formula that we can use to then calculate the required rate of return for a specific asset. So that calculates the required rate of return. And again, that CAPM formula comes up. We use it in later learning units as well. Okay, so those are all the different things that we're going to have a look at. So the beginning part of this chapter, if you guys have got your textbooks in front of you there, if you go through, and it is important that you read through everything and highlight and make notes, because as you can see from these learning objectives, this beginning, but yeah, fundamentals of risk return and risk preferences, this is all of the intro section. And have a look at the definition of the risk. So when we're talking about risk, and then specifically risk in investing and in financial management terms, usually when we say something has got risk in it, we're looking at what is the potential or the probability of the threat of damage or something going wrong with a particular event, for instance. So it's quite similar for finance, where we just say that risk is the probability that the outcome that we're expecting from our investment will not take place. So we are very much in this chapter working with interested in probabilities. And also, as soon as there is uncertainty, then there is also risk present. You guys can read through the section definition of risk and go through example 3.1 yourselves. 3.1 is important because it's also showing you how the size of the probability of something happening or not happening affects the risk. Then this word over here, the range, is the size of the range tells us the size of the risk in a particular asset. So the larger the range, in other words, the possibility of having a very high outcome and a very low outcome, the larger the differences between those two probabilities, the larger the risk. If the range of the possibilities of the outcomes is quite limited and small, then the risk in that asset is much smaller because it's obviously then going to be much more, the outcome's going to be more predictable. Definition of return you've got on page 69 in your textbooks, and there is that little formula for definition of return. That little formula is on your formula sheet. The CAPM formula is also on your formula sheet. Let me just double check that that one is on here. Yeah, it is. So you don't have to memorize any of those, but you do need to understand them so that if you need to use them, you know how to use them. Then this section over here, risk preferences. This is also an important principle that you need to understand, and that's on page 70 and 71 in the textbook. And this is quite simply, again, read through it and understand it, that an investor is either going to be risk averse, risk neutral, or risk seeking. So that just means what level of risk is that particular investor willing to take on board. And that will then dictate what type of investments that investor is looking for to add to their portfolio. Then describe the procedures for assessing and measuring the risk of a single asset, your second learning objective. That is sensitivity analysis and probability analysis. So sensitivity analysis is also what we call what-if scenario plannings. So we just have a look at our asset and say, what if this particular aspect changed? How would that affect the return of the asset? So how sensitive is the outcome of that investment to changes in various factors? And that's also where they talk about range. So if you go to example 3.3, you will see the demonstration of working out what the range is and how that then tells us information about the amount of risk and the sensitivity of that asset to changes. And then probability analysis, example 3.4. Probability analysis is where we want to be able to assign a probability percentage to the various possible outcomes of an event. So if we've got, for instance, in example 3.4, you say we've got 2 projects and there are 5 different probabilities in what the outcome could be. It could either be very bad, bad, as expected, good, or very good. So 5 different outcomes could happen. And then in the probability column, we've assigned a percentage probability to each of those 5 possible outcomes. So here again, this is when you're just looking at a single asset. So yes, they are talking about in both example 3.3 and 3.4, project 1 and project 2, but we're looking at each of those projects individually. We haven't kind of like put them together. We're assessing project 1 on its own and we're assessing project 2 on its own. in terms of sensitivity analysis and probability analysis. So then to be able to calculate the expected return of a single asset, the calculation at the end of example 3.4, you'll see underneath the table of the 5 different outcomes, they say the expected returns of each project are calculated as follows, and then you've got the 2 calculations. So quite simply, you can see what we are doing is for each possible outcome, we are taking the percentage probability and multiplying it by the percentage outcome if that probability took place. So in other words, we're saying for project 1, if the outcome was very bad, the return would be 15%. There is a 12.5% probability of the outcome being very bad. So the expected value, to calculate the expected value, we take 12.5% times 15%. And then we add that to the same calculation for the bad outcome. There's a 17.5% possibility the outcome could be bad. And if the outcome was bad, the return would be 25%. So we take 17.5% times 25%, and we add that to the calculation we did for the very bad outcome. So we do that calculation for each of the 5 outcomes, we add them together. So it's basically a weighted average that we are calculating. If you guys know what a weighted average is. So for project 1, we do the calculation for each of the outcomes, we add them together, and we see that the EV, or the expected value of that project, is then 34.75%. So what we've done there is we've realized there are 5 different possible scenarios that could happen. We assigned a probable return for each of the scenarios, and we assigned a possible a probability to each of those outcomes. And using that, we then calculated an overall expected value of the return of that particular project. So they do sometimes, and at that calculation, we then build into other things that we do later when we are looking at calculating expected value. Okay. So that is basically quite important. So question 3.3, you guys can definitely do question 3.3, and that will give you some practice in calculating ranges, calculating expected returns, and then making a decision as to which project you should choose based on which one has got the least amount of risk. And if you can do question 3.3, then that will consolidate your understanding of all of this first section of the work. These calculations for standard deviation and coefficient of variation, I'm going to not do that this evening because I'm going to include that in questions that we're going to do in those 2 revision in the 2 revision sessions where we're going over past question papers, etc. And I will also post some mock tests or practice tests for you from past papers also in your more resources, also including questions of that kind. It's just easier to do it using a past paper. And the same thing when we're measuring the risk and return of a portfolio. Those calculations also we will look at when we are doing those practice questions, where we go through past paper questions. So I just want to share another set of slides with you now. So now if you go through to page 79 in your textbooks, your page numbers could very well be different to mine. I've got quite an older book. And then we can have a quick look at these slides, by the way, guys, are already in your more resources. Have you guys gone and had a look in your more resources? Please go and have a look in your more resources. I've been uploading things there as I come across things, and all the various materials and resources that I usually use for this module. I've been uploading them there. Please go and have a look. They because the sooner you start working with them and using them and being familiar with them, the better, both for your test 2, task 2, and for the exam. Lots of the links to the videos in YouTube. The sooner also you start going through that, the better, because there's hours and hours of past exam paper recordings, etc. there. And if you suddenly start looking at those just before the exam, you won't have time to go through all of them. So start listening to those videos now already, so that you are familiar and you know what's there, and you start working with those already. The slides that I've got are all already there. I've uploaded your formula sheet so that you can also download it and print it and start working with that. What else? There's quite a few other things there, so please go and have a look in your more resources. Okay, so let's just have a look. So these slides that we're going to look at now cover the aspects of correlation and diversification. I think they also cover international assets, and also then systematic and unsystematic risk. So basically the whole next section of the chapter, and then there's a separate set of slides for that last little section, CAPM, the capital asset pricing model. Sorry, just give me one sec. Okay, thank you. Okay, so correlation is an important concept also in investing, and when we also, particularly when we are looking at portfolios. So in risk and return, we look at how much correlation there is between all of the different assets in our portfolio. And it's one of the principles that we use when we are building a portfolio. In other words, when we are adding assets to our portfolio, one of the things we'll look at before we add an asset to our portfolio is how does this new asset correlate in terms of risk and return with the assets that I currently already have in my portfolio. So that's the reason for looking at correlation in terms of risk and return. So correlation, just as you can imagine, as it means in English, is correlation means, is there a relationship between the two variables? In other words, when I look at the behavior of one of the variables, can I see that behavior reflected in some way in the other variable as well? When something is positively correlated, then we say that there is a relationship between the two, and they are moving or acting, behaving in a similar direction, behaving in a similar manner. So that means when the one goes up, the other one goes up as well. When the other one tends to drop, the other one will also tend to drop. So they might go up and go down by different percentages or different ratios, but they move in the same direction. if something is negatively correlated, it still means that when the one variable moves, the other one also moves at the same time. But in this case, when the one moves up, the other one will move down in the opposite direction, and vice versa. So correlation doesn't just mean they both go up or they both go down at the same time. That just means that that's positively correlated. If they move at the same time but in opposite directions, then that's still correlation, but it's negatively correlated. And in your textbooks, you've got that diagram on page 79 where they show you two lines moving, flowing next to each other, up and down together for positive correlation. And then you can see next to that the diagram for negative correlation where they are moving but exactly in the opposite direction. So they still form a pattern together, but it's just a different kind of pattern. If you turn over the page in your textbooks and you go to the section where we talk about diversification, have a look at the diagram on in that section. So there you can see we've got two assets, A and B, and these lines going up or down, we have traced the returns of the assets over time. So over time, B went up and then it went down and then it went back up. And over the same period of time, asset B went down and then it went up and then it went down again. So you can see if you look at just the lines A and B together, those two assets are negatively correlated. Then the darker line that runs through the two assets, you'll see is a much flatter line than either the A or the B line. So what we've measured with that line is then the return of the portfolio A plus B as a whole. So you can see what we've done there is we have controlled the very big swings up and swings down in our returns by having in our portfolio two negatively correlated assets, because we are still getting returns from both of the assets, but our portfolio as a whole is much more stable because we've got negatively correlated assets built into the portfolio. So this is what we call the concept of diversification. And this is one of the reasons why we want to measure correlation between our assets and potential assets, because as investors, our aim, our goal is to have a diversified portfolio, which means that our portfolio as a whole has then got less risk in it. And we are balancing our risks and returns. So here they say when you can only achieve diversification if you have got more than one asset. In other words, you've got a portfolio, and this is a means of spreading the risk and reducing the risk overall as an investor. The one thing I didn't mention when we're talking about correlation is if you've got two assets and you will always have movement up or down in either one of them. If we've got two assets and the one moves up or down and the other one also moves up and down, but there doesn't seem to be any link between the two in terms of the pattern of when they move or by how much they move or in which direction that they move, then we say that those two assets are not correlated. There's no relationship between the two assets at all. So we can get positive correlation, we can get negative correlation, and we can also have no correlation. No correlation means I can't find any link in the relationship between those two assets at all. So that would also help us in a diversified portfolio, is to also have assets that are negatively correlated and also some assets that are not correlated with each other at all. And then also we might have some positively and negatively correlated assets as well in building up a large portfolio. But overall, what we are aiming for is that dark line in that diagram in the diversification section is where we're aiming to stabilize and balance out the returns in our portfolio over time. And that's us trying to control our risk. So correlation and diversification are two very important aspects of risk and return and building up a portfolio. So just in terms of our types of risk, remember we said there's 3 types of risk. We can be risk averse, we can be risk taking, we can be risk neutral. Most financial managers should be or would be risk averse because we're managing the shareholders' assets on their behalf. So you would want to diversify to some degree. So the use of correlation is then an important tool. So a financial manager would be looking for assets that tend to have either negative correlation, in other words, move in opposite directions, or otherwise zero correlation, and they're not correlated at all, because that will then reduce the variability, in other words, that range of returns, and thereby reduce the risk in the entire portfolio. So this graph that I'm talking about over here on this slide is that graph we were discussing already, that graph on the diversification page. And then just some notes on the impact of international assets in a portfolio. So as soon as we are taking on board assets that reside in an economy that comes from a different country, obviously their economy, their political background, and everything else will be different to that in our own country. So we would then expect that asset also then to behave in different ways. So this is another way of diversifying your portfolio, is to purchase assets in different international zones. And again, there's quite a long discussion in your textbooks on that, and it is interesting. It is one of your learning objectives, so they could always come up with a little theory question on the discussion of international assets in a portfolio. But as long as you you understand the basics behind that. And again, diversification means if conditions in one country are going to lead to poor returns in that particular country due to inflation or political situations or wars, etc., your investments that you've got in a different country would then hopefully be getting favorable returns in another. So that's also then where we are diversifying our returns. So drawbacks to international assets, obviously there is high risk in investing internationally, because now we are exposing ourselves to foreign currency fluctuations, so exchange rate fluctuations, which can happen usually not very suddenly, but they can be sudden. And South Africa, we know very well how our currency goes up and down. The political risk due to election years, particularly in years of election, and particularly if governments are changing, and then also different fiscal policies in different countries. So that will then cover some of the disadvantages of investing in international markets. So the advantages are that it helps us to build up a diversified portfolio. So those are the returns, but we've also got to be aware of the risks. Then the last section in your textbook, just before we get to the CAPM formula, is types of risk. And this is where we've got the two types that you need to be familiar with and be able to discuss in a theory question, is unsystematic and systematic. Just one second. Okay, so the easiest way also to understand this is, again, using a graph. So if you have a look at the graph on page 84 in your textbooks under 3.10, types of risk. You'll be able to see systematic and unsystematic risk illustrated for us. So when we are talking about systematic risk, if you think of and I know students often get muddled up in a question if they're asked to identify whether something is systematic or unsystematic risk, then they forget which one is which. So just remember the word system. We all know what a system is. A system is kind of like a model or a model that is working in a particular way. So if you think of a system, systematic risk is that risk that resides across the entire economy. So for instance, if we're looking at the South African investments, systematic risk would be that risk that is inherent in all assets, all industries and all types of investments in South Africa, based on those risks that are inherent, that can't be diversified away from. So systematic risk would affect all assets in your portfolio equally. It wouldn't only affect some of them, it would affect all of them at the same time. So these are things like in your economy, like inflation. So South African inflation would affect any investment in South Africa. Government policy or politics, significant weather events, wars, what are other kinds of things that would be systematic? So something systematic is something that you can't diversify away from. You can't avoid it because it's part of the system. Then when we talk about unsystematic risk, so in your graph, if you look at the graph, that the x-axis, the parallel line between the x-axis and that line that is showing us the area B, that is then systematic risk. So from point 0, where the x and y axes meet, all the way up to that dotted line, that amount of risk is always going to be present. No matter how many assets we add to our portfolio, we can't diversify below that dotted line because that risk is always going to be present. So you can see our curved line is the amount of risk in our portfolio. So it starts up high at the top of the y-axis when we've only got 1 or 2 assets in our portfolio. Then as we add assets to our portfolio and our portfolio becomes diversified, that the line will move to the right as we add in quantity of assets, and it will also move down the scale of risk as we diversify, because as we add in assets, we are diversifying our portfolio. So the risk will eventually drop until it drops to that dotted line. And then you can see when it reaches that dotted line, it then levels off and it can't drop any lower than that. So unsystematic risk is risk that is industry or asset specific. So it would be a risk that is only present in a given industry, for instance, the mining industry or the textile industry or the agricultural industry. And it's not correlated with the entire market. And unsystematic risk can be diversified. So the definition is unsystematic risk is diversifiable. Systematic risk is not diversifiable, is what you really want to remember about that. So the rest of these slides are then really just the discussion. I'm really, guys, I know our time online is very short, so I'll try and fit in as much as possible. But you've got the textbook to read through, you've got the slides you can go through in your own time, and very definitely in the textbook, the examples and the questions as you read through each section are vital to your understanding of each of the sections. But when you get to the more complicated or difficult questions in the revision section at the end of the chapter, and then questions that we get in our assessments, you are more prepared to be able to tackle those because you've understood the basics, all your building blocks. Okay. So this slide is then a description of unsystematic risk, also known as diversifiable risk, which is you must link those two and remember that. And then systematic risk, which is the market. So the market is the system, and that risk is undiversifiable. It's unavoidable. There's not much more I can really say about that we haven't already done or that you can't work through on your own. I just quickly want to see in the last 5 minutes. I hope you guys don't. Do you guys have another class that you've got to go to? I don't want to hold you up, but I'm just, if you give me 2 more minutes, 3 more minutes, I can just finish this off for you, and then you'll be able to work with the information in Learning Unit 3 on your own. So LU3 so far, this is everything that we've covered: definition of risk and return, risk preferences, so we either are averse, risk neutral, or risk seeking. Our procedures for assessing the risk of a single asset are our sensitivity analysis and probability analysis. Our procedures for measuring the risk of a single asset are standard deviation and coefficient of variation. And then the same thing, procedures for measuring the risk and return of a portfolio. We also look at the expected value and the standard deviation of that. And as I said, those calculations we will go through. Correlation and diversification we've discussed, international assets we've discussed, and the types of risk we've discussed, unsystematic and systematic. So all of that is contained in Learning Unit 3 in those learning objectives that you guys need to be aware of. So the last section is this capital asset pricing model, or CAPM as it's known. And this is a formula. And the thing that you must remember about this is that it's a formula that calculates an appropriate required rate of return for a given asset or a particular asset. That asset will have a given level of risk, and we are calculating CAPM under the assumption that the asset is going to be added to a diversified portfolio. It takes into account the systematic risk as well as unsystematic risk, in other words, asset-specific risk and market risk, and also it builds in the expected risk-free return in a particular market. I'm not going to go through all of this. These slides are there. You guys can read through that. I'm just looking for, oh yeah, this one is important. This slide is important. One of the variables in our CAPM formula is called the beta. It's the one that looks like a little fancy bee. And the thing here that you must remember is that the market, so basically the system, the market, has a beta of 1. That you've got to remember, and they often expect you to do calculations based on your memory that the market's beta is 1, because they will say in a question, for instance, work out the beta of this, work out the return, expected return of this asset if this asset has got a beta that is 3 times that of the market. So they'll say 3 times that of the market, not telling you what the market's return is, and then you have to remember the market's return is 1. That's important, so that I wanted to highlight. Then the actual CAPM formula is here. So R stands for the return. The required return of the asset is equal to, and all of these variables, you'll be able to identify these values out of any question that you've been given. If we take the risk-free rate of return in this particular market, and we add to that the beta of our asset that we are measuring, and the beta of our asset will include the risk inherent in our asset compared to that of the markets. We multiply the beta by the expected return of the market as a whole minus the risk-free rate of the market. So RM minus RF is what we call the risk premium. That amount in the bracket there is known as the risk premium. So our expected return of the asset that we wanting to measure is equal to the risk-free rate of our market plus the beta of our asset multiplied by the risk premium. And that's how we work out the required rate of return of the specific asset that we are considering adding to our portfolio. Okay, so in this section here again, CAPM, you've got pitfalls of the CAPM formula. It's always got benefits, but we always need to remember what are the disadvantages. So you can go through example 3.11 and then do question 3.8 as well. The pitfalls is also can be a popular theory question. Those are just some other aspects. These are, sorry guys, these 4 points here, these 4 bullet points are the 4 pitfalls of the CAPM formula, or the disadvantages of the CAPM formula. And each one of these pages, there's 2 of them. And here are the other 2 pitfalls on the slide. So to finish off here, you can do revision questions 2, 5, and 6 at the end of the chapter. And those are the 3 questions that will help you to practice working with the CAPM formula and making those decisions as to whether you're going to add that asset to your portfolio or not. Okay, so I have had to rush through that, but hopefully that has given you a really good overview of everything that's contained in our risk and return chapter and helped you to understand how that feeds into everything that we're doing in our financial management. Okay, guys, anybody got any questions? Any questions to finish off? Remember, all of that is in your more resources. Please go and have a look there. I will remind you guys in an announcement so that you get into the habit of using everything there and getting used to what is there. Anything else that I can help you guys with for the moment? Thanks, Chris. I shall do. You guys do. Pleasure, Melanie. Everybody else okay? Shasta, you good? Diana? No questions on your side at this point. Okay, guys, so work hard, keep up. You've got to keep up with your reading, practicing, examples, questions. It's the only way to make sure you're on top of everything by the time those assessment dates come around. Okay, guys, I'm going to close off the recording now.